How do index annuities actually work is a question that we do get a lot. So let's go over the core idea. All right. The basic idea is your money is not invested directly in the stock market. Okay. That's actually a misconception. Your money is sitting with an insurance company, but it's not directly in the stock market. The growth of the account is linked to a index. That's where index annuity comes in. The most popular that people move forward with is typically the S&P 500. So whatever growth the S&P 500 does, your account gets credited, but understanding that the insurance company sets the rules on how the growth and gains are credited. Okay, but that's the basic core idea. But what exactly happens when the stock market goes up like it did these past 3 years? Well, you're going to participate in the market gains, and the gains are based on a formula set by the insurance company. But understand some companies could cap your gains. I've seen them as 9%, 12%, 7%. Every company is different. Or your gains are limited on something called a participation rate. But do understand when the market goes up, your account will get credited based on positive stock market performance. But how about the other side? What happens when the stock market goes down? How come you don't lose money in the index annuity? And that's because of the way it's structured, right? Like I mentioned before, your money's not directly invested in the stock market. So when the stock market has a negative year, well, you're not going to participate in any negative returns. That's why typically in an index annuity, the worst you're going to perform is 0%. So if the stock market goes down 5%, you make zero. If it goes down 10%, you make zero. If it goes down 20%, you make zero. So understand that in a down market, you are protected, and on a up market, your account will get credited. So it's really based on, somebody that wants to eliminate risk from their portfolio, and are also looking for higher performance than what a savings account or a CD account will give you at the bank, right? But why does time matter? How does time work? Gains are typically locked in periodically. You could do a 1 year, 2 year, 3 year window. You could do a monthly average. Most people do a annual point to point is what they call it. Now you do lock in your gains from the previous year, which is quite exciting when it comes to index annuity. It's not a high watermark. Okay, so what do I mean by that? So let's say you have $300,000, market does 10%, your account gets credited 30,000, you now have 330,000, then the market decides to go negative, well, you're not going to go down in value. You lock in that $330,000. So the growth looks more like a staircase. You go up with the market or you stay flat in the years that the stock market is negative. Okay. And compounding, if you look at the math, especially the internal rate of return, it does work best when losses are avoided. Okay. So be careful with the average language of the stock market, 10 to 12% on average, but that could include some big down years. If you're a pre-retiree or retiree, we don't have time to wait for the stock market to come back up. We have to protect a portion of your assets. And typically, a index annuity could be the right solution if you are looking for that protection while at the same time position yourself to participate in market gains. Okay, so the big picture, the big takeaway, upside participation has limits to it. Okay, you're not going to get a guaranteed protection with unlimited upside. As I mentioned, some companies cap you at 10%, 12%, 7%. Some do a participation rate where you get a percentage of the rate of return, but you do have that downside protection, right? So that's going to be the trade-off is you participate in market gains, they might be limited, but you're not going to participate in any stock market losses. And this is a rules-based approach to growth. Every company is different, but understand an index annuity can protect your portfolio while you're maintaining growth against the growth of the stock market. Okay. So if you have additional questions, I put together this free educational guide, Smart Growth and Safe Returns. The link is below. Request a guide. I'd love to talk to you, answer any questions you may have when it comes to index annuities. Thanks for watching. If you found this helpful, hit that subscribe button today. And if you're ready to take the next steps, feel free to schedule a discovery meeting with Core Financial Partners. Until next time, take care and keep building smart.